Let's pretend you're going on a road trip. You gassed up the car, you packed your clothes, and you have your favorite snacks within reach. The next step is to put the car in drive and make your way to the destination. Now imagine before you shift the gear to drive that you're forced to wear a blindfold. This is exactly what it's like for retirees who don't have a plan for their taxes in retirement. And to make it even worse, they have no clue they're even wearing the blindfold. Today, we're taking the blindfold off and talking about three of the most dangerous retirement tax traps and a powerful strategy to avoid them. Welcome back to the Retirement Switch. I'm Garrett Borbina. Last week we talked about the difference between looking in the rearview mirror with tax preparation and looking through the windshield with tax planning. Today, we're putting that planning into practice. We're breaking down the big three traps: RMDs, or required minimum distributions, Social Security taxability, and the IRMAA cliff. Now, don't worry if those concepts are completely foreign to you. I'm going to explain each one and then move into the strategies we use to disarm them. The first trap is the required minimum distribution, or oftentimes called an RMD. For those of you that are unfamiliar, an RMD is a specific amount that the IRS makes you take out of your retirement account every single year until that account balance hits zero or you pass away. At the start of retirement, the IRS didn't much care if you took money out of your 401k or traditional IRA, but in your mid-70s, that script changes a bit. In 2026, the age RMDs begin is 73. This means that if you turn 73 this year, it's officially time for you to begin pulling money out of your tax-deferred retirement accounts, whether you need that money or not. Worse yet, every year that goes by, the percentage that comes out gets higher. This means that once RMDs start, it's a ride that only goes up. Now, this increase in taxable income can get bad enough to a point where more items are impacted, which leads me to our next trap: Social Security taxability. This is one that we find a lot of retirees do not quite understand and make mistakes that can really cost them. There's a lot we could dig into here, such as the timing of Social Security, the change in benefit amounts, but we'll save that for a future episode. For now, let's focus on how much of your benefit the government gets through taxes. The IRS starts by using a special math calculation to determine what's called your provisional income. Depending on where that number falls, your Social Security could be tax-free or could have up to 85% of your benefits as taxable. Now, that's a pretty big difference, and the window for wiggle room is not all that high. If you're married and filing jointly, there's only about $12,000 worth of wiggle room to decide if you're paying nothing in taxes on your Social Security or upwards of 85% on it. Look back to the first tax trap. And now with RMDs on top of your previous income, it's almost a certainty you're paying taxes on the max amount of your Social Security. This means it's incredibly important how retirees structure their income in retirement and also strategize early on to better avoid these traps. The third tax trap is what some call the stealth tax, because it doesn't even show up on your tax return. It shows up as a deduction from your Social Security check or as a bill for Medicare. This is IRMAA, which stands for Income-Related Monthly Adjustment Amount. Most people pay a standard premium for part of their Medicare health insurance. For Part B and D in 2026, this would have been $202.90 per month. Now, if you make too much money in a given year, you pay an additional charge on top of that $202 amount. This additional charge can range from $95 per month to as much as $587 per month, depending on your income. Oh yeah, and that's per person. This is one of those traps that most people do not see coming, yet it can absolutely be avoidable. This is a perfect example of why you cannot just look at a single year at a time for taxes. This is also a perfect example of why a good financial planner who does tax planning can make all the difference. I'm going to stop here and just say, if you're working with somebody who only talks about your investments, it may be time to ask some additional questions or possibly look elsewhere. It's likely they are also wearing that blindfold, which is something you definitely do not want in your tax professional. So now that we have identified some scary tax traps, let's switch gears and talk about some ways to get ahead of them and do some good tax strategizing. A strategy I want you to consider is one of my favorites, and it's called a Roth Conversion. How this one works is fairly simple. You're taking money from your tax-deferred bucket, paying taxes on it, and moving it to a Roth where it will grow 100% tax-free. Let's take a look at a pretty basic example of this. In this scenario, we have a couple in their 60s, retired with Social Security and then a pension. In addition to that secure income, they have about $1.5 million in tax-deferred retirement accounts, which they don't really have a need to tap into. Within their goals, we talk about these retirement accounts being legacy-oriented, meaning they want these dollars to go to their kids when they pass. What I want to see as their financial planner is what this legacy will do to their future taxes. So as a good financial planner, I want to run what's called a lifetime tax projection to see what we are estimating their total taxes to be paid over the rest of their lives. In doing this, you can see on the screen, we are estimating roughly $750,000 to be paid in taxes during their retirement. Now that number alone is a shock, but we need to see a bit more to diagnose the problem. Let's look at how much is being paid each year of retirement. Here, you can see their taxes each year stay relatively low until age 75. Then, all of a sudden, the taxes triple and continue to rise year after year. This immediately tells me we have an RMD problem to solve. Now let's add in the Roth conversion strategy. Our target for this specific scenario is to max out the 12% bracket year after year until those RMDs begin. Let's see how the graph changes. Okay, so you can see we are paying a little bit more in taxes now in order to avoid that big jump and paying much higher taxes later. In total, utilizing the Roth conversion strategy results in about $200,000 less in taxes paid compared to doing nothing and facing those bigger RMDs later. We also know that by maxing out the 12% tax bracket, that we are keeping your income lower and avoiding IRMAA both now and down the road. This is the incredible power of good tax planning. This is why we hammered home that having the annual goal to pay the least amount of taxes each year can cost you thousands, if not hundreds of thousands, down the road. Other really good tax strategies you want to make sure your advisor talks about are Social Security timing, tax deduction maximizing, especially if you're over 65 with that new senior bonus. If you're charitably inclined, look at qualified charitable distributions, donor advised funds, or scholarship donation funds. There are so many more great strategies that can impact both what you pay now, but more importantly, the total you pay over your entire life. Don't settle for lower taxes now because it could very well be costing you significantly more down the road. As always, make sure you talk with a financial planner before implementing anything you see here. Let this video be a good guide for ideas and strategies you can work with your planner together on. If you enjoyed this video and want to see more, go ahead and hit the like and subscribe button. If you want to help drive future topics, toss a comment down below. Thank you so much for watching. I'm Garrett Borbina, and this is the Retirement Switch.